It's that time of year again. It's my pleasure to introduce Ankit Sharma, one of my partners, to talk all things tax and year-end planning. Ankit, let's dive into it.
Thanks for having me.
From a big picture perspective, before we dive into tax planning, what do we start to talk to our clients about this time of year?
So I think year-end tax planning is always a time of reflection and also capturing the opportunities that sort of present themselves. So to me, it's always asking that. There are probably three core questions. So first is, what's changed in the tax world? Is there something that significantly impacts our clients? What's changed in the client's world? Have they had a major life event? Have they sold a business? Have they sold a property? What does that sort of lead on to? Is it small business CGT? Are we talking about additional deductions, different types of tax planning to prior years? And then I guess it's also just understanding whether the structure itself is still sort of relevant and the interaction between, so the self-managed super fund, family trust, corporate beneficiaries, private ancillary funds, and just making sure that all kind of fits together as a starting point.
And would you recommend that it's, every couple of years you look at tax planning, or is it an every year thing that we go through with clients?
Definitely every year.
That was a quick response.
Definitely every year. But I think probably what's worthwhile every couple of years is doing that further deep dive. What does the family balance sheet actually look like? Are the estate plans in place, personal insurances, and the debt profiles as well, just to sort of step back and look at that more holistically.
Cool. And let's go through each of the spokes of tax planning. Let's talk about super. What are the things we should think about there?
So superannuation can be a topic on its own, but I think probably going back to basics. So what have we got? We've got the two major types of contributions. So you've got concessional contributions. They're the ones that someone's claiming tax deduction for. So either your employer, your business, or alternatively, they're being claimed as tax deductions in your personal name. Annual cap of $30,000, 15% tax paid within the fund, but then someone gets a tax deduction along the way. Mm-hmm. That's sort of pot one. Pot two is in what we call the non-concessional. So that's $120,000 per year, or you can bring forward $360,000. If you're going to bring forward, definitely speak to a professional on that, just to understand what that looks like. I will note that there is an expectation that the rates and thresholds will be indexed. So those are the 30th of June 26 thresholds. If you're looking at trying to maximise what's happening in the super world, probably best to sort of get that formal professional advice.
And some other ones that we're seeing quite prominently are people that are looking back and using the unused caps.
Yes.
Is becoming quite a thing to do. A little bit tricky to unwrap and work out what you haven't used and do you qualify to be able to use those caps, but something that we're deep diving in with a lot of clients. The other one is, with intergenerational wealth transfer and people downsizing, the downsizer contribution caps are starting to come part of people's strategies as well. So some really interesting ones to start, not necessarily waiting to the end of the financial year to get some of these super strategies in place, but start to research, think about and make sure that we're moving things in the right direction leading into 30 June.
And a lot of super contributions are use it or lose it. So probably the one primary exception is that if you've got less than $500,000 worth of super, you might be able to do catch-up concessional contributions. And that can work really well, particularly if there's a significant capital gain or something like that along the way. And I think one thing that clients do occasionally sort of miss is the fact that, putting our estate planning sort of hat on here, is that superannuation doesn't automatically fall into the estates and the wills. So that's the need to do the binding death nominations and the like.
Really important.
Sometimes overlooked, but that's when you do the zoom back, you go, look, make sure everything sort of, it kind of fits within each other and all the objectives kind of flow.
Cool. Talk to us about personal tax.
So some of the I guess from a personal tax perspective, the rates, there's a slight change in one of the marginal tax rates by about 1%. So there is that sort of small winner potentially looking at deferring particularly income into the future years. But that tends to be a minor win because it's generally just a timing benefit. The superannuation piece is obviously a big part of it, which we've just spoken about. but then also making sure that you're keeping records of all the deductions that you're seeking, because that's a significant area of focus for the ATO at the moment.
All things business and trusts. Talk us through from a business perspective. Are people buying utes and writing them off still? What else are we doing this time of year?
So never a good idea to buy a piece of equipment just to get a tax deduction. But
very true.
There's definitely the instant asset write-off still in place. So that's $20,000 per sort of piece of equipment. Most utes probably wouldn't fall into that category, but I think it's important to make sure what's acquired is for the benefit of the business, not just to get
a tax deduction.
Exactly, benefit from the tax man. So I think you've got what's on the depreciation schedule, what are the capital items you bought, are we valuing stock appropriately, have we looked at revenue in advance, so have you billed something but haven't actually done the work, that might not necessarily be taxable in the year. And several other things, which I would call sort of the basic financial hygiene things that you would do. Again, on the super front, if you're a business looking at trying to claim a tax deduction on superannuation, it's based on cash payments, so definitely make that prior to 30th of June, rather than sort of on accruals basis that most other deductions would be. Also on the super front, we significant discussions around, paying super as wages are paid, and that's sort of coming in on the first.
Same day payment.
Yep, correct. That's coming in from 1st of July 26. So for most business clients, that's more of a administrative change internally, but for some, it's a significant cash flow impact, particularly for those that have significant payroll requirements, have made the use of the pushing out to the end of the quarter payments.
Now, talk to us, yes, we've talked about it from a strategy or from an advice perspective, but what are the areas of focus from a tax office perspective? I know there's been lots of discussion around the fact that interest from the tax office is no longer deductible. What are the other areas that they're sort of turning the dials on to make strategies change?
So the ATO's cottoned on that they're in the business of collecting tax revenue, so that general interest charge deductibility change from 1 July 25. And the ATO has become much stricter around general interest charge remissions, penalty remissions, and even as tax agents, the need to lodge at least 85% of our clients on time. Otherwise, we potentially could lose some of our concessions and ability to defer sort of lodgement for our clients themselves. Other areas, the ATO definitely gets data from both domestic and international sources, so crypto transactions, rental properties, particularly holiday homes and the like.
Personal use on holiday homes, things like that.
Exactly. ATO is keeping an eye on that. They're looking at the international space, operating or investment companies overseas. Are taxpayers correctly dealing with the integrity provisions, control foreign company, transfer pricing and the like? And probably it's just more of a focus on the record keeping and making sure that people are claiming what they're meant to be claiming, and also declaring all their income from whether it's Airbnbs or whether it is from sort of non-employment related activities.
I think that the long and short of what you're saying is the world's gotten smaller.
Definitely.
Data's got richer, and the tax office has found that data, and they will be interrogating it. So the little slip up of something that you might have previously not disclosed or put into, be warned, be forewarned that information is now available to the tax office.
Exactly. And we're seeing it with people that are sort of on the platforms, Instagram and the like, where in the past the data matching necessarily wasn't there. Now it's being flagged. It's important to be able to keep records and also include those sort of things in the tax returns. Going back to your earlier question on trusts, I think something that's on the ATO radar is making sure that each year trust needs to distribute income to its beneficiaries. So it's choosing those beneficiaries, documenting that via year-end trust resolution, but also then making sure that those beneficiaries are receiving the benefit of those funds. And that particularly for children that turn 18, that they go to uni, they're on those lower tax rates, but parents we find tend to spend money on them. So we kind of find that's sort of a nice middle ground to go, here's some income to fund university, but we're going to also have that tax in your personal name. So, yeah, something to be aware of.
Excellent. Well, Ankit, as always, fascinating perspectives. Really appreciate your insights. For those listening along, it isn't too late to start your tax planning. It's probably better to start earlier, get into it. There's a lot of complex issues to cover off, and make sure you dot your I's and cross your T's before the end of the financial year.